afternoon, ladies and gentlemen. Thank you for joining us. MoneyShow is delighted to welcome Ed Yardeni, President with Yardeni Research Incorporated. Dr. Yardeni is a provider of global investment strategy and asset allocation analyses and recommendations. He previously served as Chief Investment Strategist of Oak Associates, Prudential Equity Group, and Deutsche Bank's U.S. Equities Division in New York City. Dr. Yardeni taught at Columbia University's Graduate School of Business and was an economist with the Federal Reserve Bank of New York. He is frequently quoted in the financial press, including the Wall Street Journal, the Financial Times, the New York Times, the Washington Post, and Barron's. Thank you so much for joining us today. The floor is yours.
Thank you very much, and thank you all for joining me today. We have half an hour, so in a relatively short period of time, I'm going to talk about the outlook for the rest of the year, for the rest of through next year and through the end of the decade. When thinking about this decade, I think there's two alternative scenarios. One that naturally comes to mind is since it's the 2020s, maybe it'll be the roaring 2020s. There are similarities between this decade so far. It's kind of early in the decade, but there are similarities already between this decade so far and the 1920s. Before the 1920s, there was a world war. We didn't have that similarity, but it did kill millions of people. And then that was followed by a pandemic, the Spanish flu of 1918 and 1919. That killed millions of people. This time around, we have a pandemic. It's killed a lot of people, but not at the scale of either World War I or the Spanish flu pandemic, but nevertheless, it's been extremely disruptive and somewhat deja vu all over again in terms of the two decades. The 1920s started out with a very severe recession. Back then in 1920, they called it a depression. So you can imagine what it must have been like or just imagine what it must have been like if you were sitting there or standing there thinking about the rest of the decade in 1920. It must have been pretty depressing after all the horrible things that had happened. So it must have been pretty hard to imagine that anything could go right. But in fact, everything did go right, or a lot of things went right in the 1920s. Most importantly, they had a huge technology revolution, electricity, appliances, light bulbs, lights, tractors, just a whole radio, just a whole host of technological innovations that increased productivity and increased the standard of living dramatically. Now, of course, the 1920s, when people talk about it, they always recall that it ended badly, that in 1929, there was a great crash in the stock market. And then that was more or less marked the beginning of the Great Depression, which actually started in 1930. So it wasn't part of the decade. But people have sort of this unsettled feeling about the 1920s that, yeah, it was great, but look how badly it ended and how long it remained bad. Well, here we are thinking about the rest of the decade, and we've had a pandemic. We're still in the pandemic in many ways. We had a unprecedented recession last year, but it was terrible, but it only lasted 2 months for all practical purposes, at least in terms of most of the macroeconomic indicators. And here we are looking at the rest of the decade, and now we have lots of things to worry about. Especially inflation is one of the big concerns. That was not a real concern in the 1920s. Back then, it was more depression and deflation. But here we are starting out the decade worrying about a very unsettling kind of economic phenomenon. So the alternative scenario to the roaring 2020s, which seems more plausible right now, given what we're seeing, is the great inflation of the 1970s all over again. Call it the Great Inflation 2.0, kind of a second version of that. And there are definitely similarities there. In the 1970s, at the beginning of the 70s, Richard Nixon closed the gold window. The dollar took a dive. Commodity prices soared. Gold soared. Food prices soared. We had two energy crises, so oil prices soared. All those soaring prices went straight into wages. We had a wage price spiral to a large extent because unions were very strong back then, and they had labor contracts that had cost of living adjustments. And so when food and energy prices went up, they went almost directly into wages. And as wages went up, as costs went up, businesses found that the only way that they could stay in business is to pass those costs through into higher prices. So we were kind of chasing our own tail there, and we had the wage price inflation spiral. One of the things that was really driving that in the 1970s was productivity. Productivity was horrible. Productivity collapsed from the mid 1960s. It was about 4%. It dropped to about 0 by the end of the 70s. So productivity growth exacerbated the situation, because if we had productivity growth, then presumably wages could have gone up, and that could have been offset by productivity, and prices wouldn't have had to go up. So we wouldn't necessarily have had that wage price spiral. And I think that's the big difference between the decade ahead and the 1970s. At least that's what I think will be a big difference. And that is, productivity growth looks to me as though it's actually picking up. On a cyclical basis, it actually made a low in 2015 of about 0.5% at an annual rate. And I'm looking at kind of 5-year averages. So in 2015, over that previous 5-year period, it was a pathetic growth rate of productivity of only 0.5%, but wage inflation was low. And as a result, we didn't really have a lot of cost pressures to pass through into prices. So we had continuation of a very agreeable environment, of very low inflation that basically started in the mid 1980s, that continued into the 90s until now. And now we see that inflation is picking up, with wages rising at a faster pace and prices rising at a faster pace. So frankly, we clearly have lots of evidence of a wage price inflation spiral right now. But I think underneath it all, we're going to find that companies are going to respond to the current situation by increasing productivity further. So that 0.5% annualized growth rate in productivity during the third quarter of this year was already up to 1.6%. It was actually 2% the quarter before that. So that's a tremendous increase. And I'm thinking that productivity can go up to 4%. We did have a setback in the third quarter. Productivity was very weak in the third quarter. Well, what happened? We hear about how there's labor shortages and companies are doing the best they can to automate and so on. But it takes time to bring in new technologies. We know that companies are buying robots at a record pace here, not just manufacturing companies, but even retailers and others. So we know all that is happening, but it does take time to bring these technologies in. But on top of all that, we've had supply disruptions, and it's pretty hard to increase your productivity when you have a real shortage, not just of labor, but of parts. For example, Ford has been manufacturing these pickup trucks that they can't sell because they're missing semiconductors, and they've got something like thousands of Ford trucks sitting there in the Louisville, Kentucky Speedway, just waiting for those parts. So again, we've had some problems on a short-term basis. Question is whether the supply disruptions are going to be transitory, persistent, or something more permanent. I think they'll persist probably through the middle of next year, but I think companies are scrambling to figure out how to resolve these disruptions. Now, how do we get here? Well, we had the pandemic. Let's look at some charts here, because I think that'll be a good way to kind of visualize how we got here. I mean, we've all been through this together, so it's definitely a shared experience, and the charts should kind of show you what we've all been through so far. Hopefully from here on, it's a lot better. But as you can see, this is the healthcare crisis, and we had this basically first wave here in hospitalizations and positive. Let's just focus on the hospital patients. That's really what matters most. And so you can see that the hospitalizations picked up a lot. We had the lockdowns in March and April back here. Then things kind of settled down a little bit, and then we had the hospitalizations picking up again at the end of last year. Maybe the holidays had something to do with it, Halloween, Thanksgiving, Christmas, Super Bowl. But as you can see, the hospitalizations started coming down earlier this year. We started getting the vaccinations, and things started to improve. Then the Delta variant came in. Not everybody had been vaccinated. There's still a lot of people that haven't been and might not be, which still makes us prone to maybe another wave of this thing. But I think we basically have gone through 1, 2, 3 waves. I think we've sort of learned to live with this thing. Unfortunately, it looks like it's just not going to go away, and that some people are going to be taking vaccinations. Some are going to get sick and maybe take therapeutic medications. But one way or the other, I think we're going to find that like the influenza virus, we're going to be living with it maybe for quite some time. Meanwhile, you can see the impact that we've had on the economy in terms of real GDP. And I'll grant you the path of GDP has been different than what we've seen in the labor market. Labor market's taken longer to recover for all kinds of reasons that we don't have time to discuss, but I'm sure you're quite aware of. But as you can see, real GDP took a dive there when we had this 2-month recession. And then it was over, and the real GDP started to recover as the lockdowns were lifted and as social distancing regulations were eased somewhat. So we've had a V-shaped recovery, and now we ran into some supply disruptions. Maybe we've satisfied more than enough demand for goods and services, so we've seen some slowing down. But we're also maybe simply getting back to the trend. And what I'm showing you here is real GDP next year growing around 2.5% to 3%. It could do better than that if the productivity story shines through, which it might, but 3% would be pretty good. And keep in mind that the labor force just isn't growing at all. It's the labor shortages, again, there's all kinds of reasons for them, but I think the fundamental reason is chronic labor shortages related to demographics. The baby boomers, the oldest of them are turning 75. More and more of them are retiring, and they're barely being replaced by as many new entrants into the labor market simply for demographic reasons. The labor shortages are basically in the DNA of the population. The outlook, I think everybody agrees, is something like at most 0.5% increase in the labor force. And the arithmetic of real GDP is really simple. It's the growth in the labor force plus the growth in productivity. So if the labor force is barely growing, the economy will barely grow unless productivity shines, which is what I'm expecting it will do. So again, this is what we've all been through. We all recall that despite the recession, we've never seen an increase in personal income in a recession, but that all happened because the government came in with a huge amount of fiscal and monetary stimulus. On the fiscal side, we had 3 checks. You can see that the 3 check payments to millions of Americans here, and here. If you take out the government fiscal stimulus, this is what personal income has done. And so it went into a dive as people lost their jobs or stayed home and couldn't work. And then it had a V-shaped recovery. And now we're back to trend. But all the stimulus hasn't gone away. Some of it is piled up in demand deposits. Some of it is an M2. A lot of it's been saved, and that means that there's lots of liquidity to keep the economy growing, and there's lots of liquidity that might explain why, for those of you who are bearish, why the stock market keeps making new highs in the face of extremely high valuations, and in the face of the beginning of tapering by the Fed, higher inflation, and the perception that rates might have to go up faster. And yet here we are with the stock market continuing to perform so well. Well, part of the story is all the stimulus has stimulated the economy and stimulated corporate earnings, and corporate earnings have been fabulous. And on top of all that, there's all that liquidity, which is keeping valuation multiples high. And not to keep you in suspense, I think the market continues to move higher. I remain bullish. I think my year-end target could be achieved by the end of the week, 4,800. We're pretty close to my year-end target. And then I'm looking at something like 5,200 next year, 5,500 the year after that. So that's not very big increases, but it's consistent with an outlook where earnings continue to grow and valuation remains historically high. I don't think there's any controversy that if there's no recession, earnings will continue to grow. The controversy is whether in an environment where inflation is high, we might see somewhat higher interest rates, whether valuations could stay this high. I've been doing some work that shows that when you slice and dice the stock market, most of the high valuation is in the magnificent eight stocks. What used to be called the FANGs when there were four. Now there's 8 of them, and they've had very good growth, but they also have their multiples up to something like 35, 40 on a forward PE basis. Take them out, and the S&P 500 has a multiple of about 18, which is high, but it's not nosebleed levels. It's not. It's more fair value than it is overvalued. And then you look at small cap, mid caps, and you're going to find some good values there now. Though last week I think we started to see them outperform, and so they're not as cheap as they were, let's say, about a week ago. But again, all the stimulus, look what it did to demand for goods. They absolutely soared. Services have been lagging behind because of the social distancing issues, but they're coming back to the trend. And all in all, consumption has been leading the economy higher. You saw retail sales came out today. They were up 1.7% month over month, so it was a big increase. But certainly inflation's eating away into some of these gains, because if I were to adjust these series for you for the level of prices, what you'd find is that there's basically been no growth or very little growth in real consumption in the past few months, because the increase in nominal spending has been offset by the fact that people are simply paying more for these things. I think we're going to continue to have a very strong Christmas season, maybe one of the best ones ever, because I think everybody knows that there could very well be nothing in stock by the time you get near Christmas, a week or two in front of Christmas. So I think I've observed in our local mall here in Roosevelt Field in Long Island, places absolutely jam-packed, and people are buying like crazy, standing in lines outside stores. Part of it is that there's help wanted. My daughter, who's a teenager, went to one of the stores, and they offered her a job. So you can go to the mall now, stand in line. You can buy at Abercrombie, and they'll offer you a job as well, especially for the holiday season. So it's hopping out there. Housing was hopping earlier this year. It's kind of slowed down somewhat, simply because we seem to be running out of inventory, and home prices have gone up too much. You can see this is home prices up something like 20% on a year-over-year basis. It's phenomenal. It's actually bigger increases than we had before the financial crisis back here. Things are slowing down now. Let me just turn that off. Sorry about that. Let me turn off the sound for a minute. There we go. I apologize for that. Where are we? We're seeing an economy that is looking pretty good, with a tremendous amount of liquidity that should continue to move it higher. Now let's get to back to the roaring 2020s versus the great inflation of the 1970s. The big story in my mind, what will make or break one scenario or the other. And by the way, it doesn't have to be one or the other. It could be some combination for a while before we may have to wait until the end of the decade to make a ruling of yes, it was mostly the roaring 20s, or no, it was really just a repeat of the great inflation of the 1970s. I'm betting on the roaring 2020s, not on the great inflation, and mostly because of the productivity story I'm telling. And as you can see in this figure, productivity is being driven by technological innovation. And I believe that we've got technologies out there that are very powerful, they're very cheap, they're very user-friendly, and they can dramatically increase both the manual and mental productivity of workers. And that's exactly what we need. It's here just in the nick of time. And you can see that technology as a percent of capital spending in current dollars has been increasing dramatically to the point that it accounts for about 50%. And I would not be surprised if it goes even higher. I think it's actually higher because this includes IT equipment, software, and R&D spending. It doesn't include things like machine tools. And we know that machine tools have a tremendous amount of technology embedded in them. And other capital spending as well have more and more technology. So I think this is actually an undercount of how much technology is spreading in our economy. But here's the key chart. And unfortunately, it's only available quarterly, so it's available with a few months lag. So it's not going to be something that we can look at on a daily basis, monthly basis, and say, aha, this is definitely what we're seeing. But we should be able to get some evidence of it. If we see wages going up faster than prices, that would be a pretty clear indication, in my opinion, that productivity is making a comeback. And there's some evidence of that even right now. But here's the story. The productivity story is in the red line. And you can see that when you take the growth rate, and this is a smooth growth rate, so it's over a 5-year period, 20.25% change at an annual rate. So when you're looking at this point, this is telling you what you were doing in the previous 5 years. So look at this. We had a productivity boom in the late 40s, early 50s. We had another productivity boom in the 60s. We try to have one in the early 80s. We had a productivity boom in the late 90s, 2000s. And now here we are again, I think, with the beginnings of a major productivity boom that could take us to 3.5%, 4.5%. I mean, it could be better than anything we've had before. And if that's the case, that's pure gravy. It all goes straight into real GDP. So if we have 4% productivity growth and only 0.5% growth in the labor force or less, we're going to get at least 4% real GDP growth. In that kind of scenario, you can get wages. I mean, wages will rise faster than prices. Profit margins will stay high. And while the economy's demand would slow down because you have slower growth in the number of people, the number of consumers, those people will be making more in real terms. So it all fits together rather nicely, at least in theory. And I think in practice, there's evidence that it may very well be starting to play out. And anecdotally, you can watch it for yourself. Read the Wall Street Journal. You'll see there's articles about companies ordering a record number of robots. Follow all the technological innovations. We do that on Thursdays. We have a daily. And on Thursdays, we monitor technological disruptions. And our problem on Thursdays isn't to figure out, okay, what's there to write about? There's nothing to write about. Quite the opposite. It's, how do we pick what we should be writing about? So whether it's batteries or robots or 3D manufacturing, new materials, electric vehicles, there's always something to write about in the technology innovations that I think are lend themselves to increasing productivity. But for the here and now, you can see that average hourly earnings, the wage inflation has picked up. It's a mess here because the labor markets have been sort of a mess. So I'm not sure that this data is really all that useful. It'll probably be more useful as we get more of it. But on a year-over-year basis, October to October is a fairly clean comparison. And as you can see, that was 5.8% for wage increases in current dollars. You can see that the underlying inflation rate was 3.6%, but that was a September number. And we know that the CPI was up something like 6.2%, including food and energy, and might as well include that. So it does look as though right now that inflation, that we have a wage price spiral, okay? And that's, we don't want to go back here. This is what we had back here. We had wages going up and then prices getting increased and then wages going up and so on. We want to go back to this kind of environment. I don't know if we're going to get back to 2% inflation. I think we're going to get back to maybe 3 to 4% inflation by the second half of next year. So what does that mean in terms of the Fed? I think it means the Fed increases the Fed funds rate 2 times next year. Everybody's talking about the second half of next year. It might, with inflation shooting up a little bit more than they had been expecting, I think we could get those increases sooner. But I will not be surprised if the Fed is more liberal, more progressive next year than they are even this year. And if that's the case, I will not be surprised if they raise their inflation target from 2% to 3% so that they're not under as much pressure to raise prices. So I don't think they're going to cause a recession. I don't think they're going to fight inflation with a recession. And I think the economy and earnings can continue to grow. But the bond yield could get up to 2%. sometime next year. I've been waiting for it. All the fundamentals suggest it should be there now. We are seeing the past few days that the bond finally is responding the way you would think it should respond to higher than expected inflation. And as you can see, any Fed official who says that, well, inflation expectations are well anchored isn't looking at their own data. The Federal Reserve Bank of New York does a monthly survey of households, and the 1 year ahead is 5.7% for inflation. That's what people are thinking. The 3 year ahead is more like 4.2%. So that's kind of consistent with the way I'm looking at things. I think inflation is going to be 4 to 5% on a year-over-year basis for the next several months, maybe through the middle of next year. Could be a little higher than that. And then by the second half of next year, I think we'll be back down to 3 to 4%. Part of that is I do agree that supply disruptions have been part of the problem, and I think they will be resolved to a certain extent. So the central banks have started tapering. They're buying. If you look at the ECB, the Fed, and the BOJ, they are buying securities at a slower pace. As you can see here, the Fed has started to taper as it announced. So from November until the middle of next year, they're going to cut the pace at which they're buying bonds. That doesn't mean they're reducing their portfolio. They're just buying at a slower pace. So if you think about the party we've been having, and they've been the bartender filling up the punch bowl with rum punch, they're just going to fill it up at a slower pace. So maybe it doesn't overflow the way it had been. Let me just skip through here to a few kind of concluding remarks here. So the bond yield, as you can see, according to the copper gold ratio, which has been highly correlated to the bond yield, we should be at 2.5% right now. And I think the Fed's intervention in the market has kept that from happening. And as they taper it, and as inflation remains a problem, I think we'll see that closer to 2%. Not the end of the world. Don't forget that if you look at this chart, here's the 10-year back here when the economy was doing relatively fine pre-pandemic. And you can see that 2.5 is something we lived with before the pandemic. I think it's something we can live with after the pandemic. The yield curve, I think, is going to continue to steepen here as it typically does in previous cycles. But at some point, maybe after a couple of Fed rate increases, the bond yield will stop going up. And it's at that point that the yield curve will start to become narrower. But I don't see a negative yield curve anytime soon, which some people view as a scary leading indicator of recessions. Figure 17 is our Blue Angels analysis. I'll finish off with that because I've run out of time. And I'm sorry, it's only half an hour, so maybe I'll take one question. But as you can see, this is the S&P 500. It's flying in the Blue Angels here, which is analyst consensus expectations for earnings versus different PEs. So the stock market, the S&P 500, has been flying between a forward PE of 20 and 22, and forward earnings, which is analyst expectations of where earnings are going, which tends to be pretty accurate except for recessions. You can see that the trajectory still looks very promising for earnings. So we've had a melt up. The initial melt up was the PE melt up last year. And ever since then, we've been melting up. We've seen earnings melting up, earnings expectations melting up. So I remain bullish on the stock market. Within that, I think you can take a fairly broad position in the market. I like financials, energy, and technology. I think that SMID caps are particularly cheap here relative to the large caps. So I think that's a good opportunity. I'd overweight the US relative to the rest of the world. That's been kind of one of our theme songs in our work. As you can see here, this is the US versus the rest of the world, both in dollars and in local currency. And you can see that we continue to outperform rather dramatically. And some of that has to do with the so-called Magnificent Eight. This is the Magnificent Five. It's the big, now it's, as you can see, it's Tesla instead of Facebook. But the Magnificent Five account for about 25% of the market cap of the S&P 500. You add three more stocks in here, you know which ones, NVIDIA, Netflix, Facebook, and you get 30% of the stock market is made up of the Magnificent Eight, and they are highly valued. But you can stay with them because their growth rates are pretty good, or you can find value elsewhere, mid caps, or maybe some of the value stocks. So that's it for me. Again, I apologize. We don't really have time for any questions. But you can find me on Yardeni.com. I post a lot on LinkedIn. You could try our research. Just go to Yardeni.com, and there's at the top banner. You can try it there. You could look at Amazon under my name, and you'll see that I've written a few books. The latest one is called In Praise of Profits, and it's a defense of entrepreneurial capitalism. So please read it, and whether you like it or not, go ahead and we'll just review it if you have time. So again, thank you so much for listening to my spiel here, and I hope it provided you with something you didn't know and something you think might be useful.
Thank you so much, Dr. Yardeni. It was a fantastic presentation. We did go up until the last minute, so we really appreciate your insight.
Sure.
Good knowledge.
My pleasure.
All right. Thank you. And thank you, ladies and gentlemen, for joining us. And we hope you continue enjoying this week's virtual expo. And have a great day.